LPs, limited partners. All right, so a limited partner is essentially an investor in a seed fund. And they don't, when the seed fund asks someone to invest and they say, hey, would you put $1 million into my fund, the limited partner generally doesn't write them $1 million check. They make something called a commitment. And what the commitment is, let's say this is $1 million commitment from an investor, is I just commit to them on paper that I will give them $1 million when they need it. And the seed fund will call on that, I'm going to spell these wrong, I'm sure, using what's called a capital call. So a capital call is important. It means as I need money over time, I ask my investors for money and they send me a check. So if I'm an investor, I don't have to write $1 million check. I may have to write a series of $100,000 checks over the course of the seed fund. So let's look at an example fund and we'll walk through a real basic overview of how these guys make money and how these funds work. We're calling this fund the Hasselhoff Fund, in honor of my favorite actor, David Hasselhoff, who's huge in Europe, by the way. And we'll look at Fund 1 and Fund 2. The reason I say Fund 1 and Fund 2 is that seed funds and VC funds, they typically don't just raise a single fund. They're always constantly adding more money to their pool, and they're doing that by raising additional funds. So you may have a seed fund that's operating 3 funds at the same time. And that's important to understand because the number of board seats that they sit on, I'll show you, goes up. So they have less time. And then the amount of time that they spend fundraising, going out to LPs to get additional commitments, takes a lot of time from the seed fund managers. So again, both important things to understand because those are resources as an entrepreneur that you would like to get a hold of and you'd like them to use helping your company. So let's look at Fund 1 and Fund 2. This is time down here on the bottom, year 1, year 2, year 3, year 4, etc. And we're going to look at the first fund. So the Hasselhoff Fund goes out and raises $10 million, okay? They get commitments from their limited partners. And they make their first capital call, they get $1 million in the bank, and they start to make investments. So very early on, they make a $500,000 investment in company number 1. And this is what happens to company number 1 over time. So they're just chugging along, doing well, their product works, they're starting to generate revenue, everything's going fine. All the way by year number 5, they're still going, okay? Then, slightly later, they make a second investment in company number 2. After that, an investment in company number 3. Slightly later, an investment in company number 4. You get the idea. They're doing due diligence. They're going out and meeting companies. They're getting deal flow from people they know. And as they see these deals and make investments, their money starts to flow into each of these companies. Now, if a company's doing well, further down the line, this red dot here signifies another investment. They may put additional money in when a company goes and does another round. So just because they make an early investment doesn't mean that's the only investment they make in a company. So let's look at what might typically happen to a portfolio of companies. Remember, they're going to make between 10 and 12 investments on that $10 million. So, in this case, this is Fund 1, and this is Fund 2. So, company number 9 would be the first investment in Fund 2. We'll get there in a second. So, the first company runs along, does fine. They do another follow-on investment, keeps going, keeps going. At year 5, that company's still running. Remember, their duration is only 3 to 5 years. So, right about year 5, they're starting to get impatient to shut down Fund 1, and they're going to want to sell that company. So, the second company they invest in runs along and runs into some IP problems with their patents and the technology doesn't work, and they decide to just shut the company down and disband the company. So that's not uncommon. So in this case, we'll make a little skull and crossbones here. Okay, so that company dies on the vine. The next company they invest in does really well, really quickly, and they get an offer from a company to buy them, and they exit. And we'll talk about how those exits work and how the math works in this 2 and 20 video. But in this case, great. The seed fund makes a bunch of money, which they return to their investors. Or they can reinvest in other companies. Then let's say company number 4, they make an investment and they're doing pretty well, they're moving along, they're trying to maybe do a VC round, they're progressing, they're still alive at the end of this period of time. So you can see that they'll make maybe 9 investments in the first fund and they'll all be staggered. Some will live and some will die. But by the end of this duration of the first fund, 3 to 5 years for Fund 1 companies, they're going to want to start either exiting those companies or raising VC money or having them run on their own if they're cash flow positive. They just want those companies to continue pretty soon they're going to have to do exit, sell their shares through either an M&A or an IPO or some exit event, so that they'll be able to return money to their investors. Fund 1. Now remember, about halfway through Fund 1, when they've already started to make most of their investments, they'll raise Fund 2. And in this case, they'll start making investments out of Fund 2. This can be completely different investors than Fund 1. So they'll start making investments out of Fund 2. And you'll follow the same pattern. You'll have a company that does well, you'll have one that exits and sells right away, you'll have another one that survives and is cash flow positive, and you'll have one that you'll shut down. So they'll start making, they're between, again, let's say Fund 2 is a little larger, so Fund 2 is $12 million because they're doing well in Fund 1, they raised more money, so now they've got 10 investments to make, and they'll start going through this process again. Remember, all of these investments will just kind of continue out in time until they hit some exit point where they can sell their shares. So you can see how these companies have survived as well. So now they're on 1 to, potentially 5 to 8 boards in Fund 1, and they've got 5 to 8 boards in Fund 2. They're starting to get pretty busy. And not, only a couple of years later, they'll go out and raise Fund 3 out here, etc., kind of out into time. So you can see how fund managers are juggling a lot of companies and a lot of responsibilities, sitting on a lot of boards. And you can also see why they start to make decisions about selling companies 4 and 5 years in. This is important because entrepreneurs are often surprised when their seed fund manager says, I'm sorry, we have to either get investment, shut the company down, and sell the company. They really force the company to do something that might not be in the best near-term tactical business interest of the ongoing concern, but they have to get money back to their investors over a certain duration of time. So it's important to understand their motivation. Also, they make money by realizing profits. So they can't just invest money and let these companies go forever, or they would never realize any of those profits. In addition, they make management fees from every fund, so they're incented to continue raising funds. Also because they would like to continue making investments and putting money at play. So basically this is the structure of the seed fund. You've got, they're trying to do things early and provide seed money. They're generally between $10 and $15 million. They make investments about $500,000 to $1 million. So they'll invest in 10 or 12 companies. They've got 3 to 5 years to kind of prove it out. They're sophisticated, so they'll take slightly more aggressive rights than an angel investor. Remember, they have their own investors, limited partners, that they need to make happy, and they're going to make capital calls over time to gather that money. They will sequentially do investments from fund to fund, and they've got to exit those investments in order to realize profit. If you can understand this basic behavior, you'll have a lot fewer questions about why seed fund managers act the way they do, and about what kind of companies seed funds are interested in.